Hello and welcome to CMC Markets on Tuesday the 25th of June and this week's weekly market update, and no prizes for guessing what I'm going to be talking about this week. It's going to be about the plunge that we've seen in equity markets over the past few days and the surge that we've seen in European bond yields, US bond yields and UK bond yields, and I'm going to focus particularly on the key levels on US 10-year treasuries, the FTSE 100 and the S&P 500. So let's start with Mr. Bernanke's comments at last week's FOMC meeting, and it's amazing what a few chosen words, the effect that they can have on equity markets. Now, Mr. Bernanke didn't really say anything different to what he indicated on the 22nd of May. However, I think there was an expectation that he would probably pull back from those 22nd of May comments, and when he didn't, obviously we've seen the effect in the FTSE 100 and the DAX. Let's not forget that on the 22nd of May the FTSE 100 was trading at 14-year highs and the German DAX was trading at all-time highs. Since then, both indexes have declined over 800 points. Now, you can argue about the merits or otherwise of why we've seen such a decline. Bernanke's comments are part of that, but also I think you have to factor in concerns about a credit crunch in China and the possible effects any credit crunch could have on future growth prospects as well. But I think the mere fact that the prospect of a tapering of quantitative easing has sent equity markets into a tailspin suggests to me that essentially markets were getting way ahead of themselves with respect to asset valuations, and we're certainly seeing that play out and have seen that play out over the past few days. So where do we go from here? Well, first and foremost, I think let's start with US treasuries, because I certainly think that when you look at this particular chart, you can see that we've seen a massive sell-off in US 10-year treasuries. So we'll look at the chart. We can see the decline. We're looking at a weekly chart here, and we can see going all the way back to early 2007 or mid-2007, US treasuries have been in a significant upward trend, currently above the 200-week moving average, as well as being above the trend line support from those lows in 2007. So we can see straight away the market spiked higher in yields, spiked lower in prices yesterday, and now it's really a question of where do we go from here, because I think if we do break below the 200-week moving average, then we could well see further rises in yields. But it's important to set this rise in yields in the context of where we've been or where we have been over the past 4 or 5 years. Yields are still at very historically low levels, especially when you compare them to where they were in 2007. It's the speed of the decline in prices that's really spooked some investors, but we still remain in an upward trend, certainly in terms of bond prices. So at the moment, and I say this at the moment, there's not an overt cause for concern. So we've talked about the weekly chart, and we can see that currently on the weekly chart we have got a potential hammer from the down move that we've seen since the May highs. If we also look at the daily chart, we can see a similar hammer. The only difference is this hammer is there, it's final, and it won't change. What we need to see now is a pullback off those lows and a move back higher. So if we see a move higher in bond prices and we stay above the lows that we've seen earlier this week, yields should come back down. Now, the highest that we've seen yields this week is 2.65%. That equates to around about 125.9 in terms of cash bond prices. So what we don't want to see is a move below the lows that we see in that chart currently. If that low remains intact, then we should start to see yields come back off. At the moment, the debate is about whether or not we see 3% or 2%. While the support around about 125.90 holds on the 10-year US Treasury, then I think the likelihood is we will see bond yields come back off from the 2.6% level and move back lower again towards the 2% level. Well, whether we'll get back to the 2% level is another matter entirely, but I certainly think that while that support level remains intact on prices, then we could see yields start to come back to around about 2.3 or 2.4%. So now let's move on to the UK 100. Now we're looking at a weekly chart here. We've seen 5 successive weekly declines. That's the worst run of losses since 2011, quite some time. So we can see straight away that we are approaching a key support level, the 6,000 level, which also happens to be the 2011 highs. So that's really a key area of support. You may also notice that just below that we have a number of other key support areas, notwithstanding the fact that you can draw a trend line from the 2009 lows, which comes in round about the 5,800 level. So there's certainly potential for further losses, but in the short to medium term, 6,000 should act as a significant support level. However, and I think you'll find this chart particularly interesting, those followers of candlestick charting, because I'm now about to show you a monthly chart, and that for me is actually very worrying in terms of further rises or further rallies in equity markets going forward. So let's move on to a monthly chart, and I'm going to show you 2 monthly charts in quick succession here, the UK 100 and the S&P 500. And these charts are particularly interesting given the run of monthly gains that we've seen in both stock markets over the past few months. Now, the June candle is of particular interest given the fact that it's going to be the first monthly decline that we've seen in over 6 to 7 months for both indexes. But the candle of most interest for me is not so much the really negative down candle that we're going to see on both, even though we've only got another 3 or 4 days to go. I think there's no doubt in my mind we're going to see significant negative month for June for both the UK 100 and the S&P 500. The interesting candle is the May candle, because the May candle, especially on the UK 100, is what I would call a gravestone doji. And those of you who read textbooks on Japanese candlestick charts will know, and will also know if you've attended any of my candlestick presentations, is that is a very bearish signal. So that suggests to me that the current gains in equity markets are probably going to struggle to reattain the highs that we've seen earlier this year. And that for me is a key concern, because now that Mr. Bernanke is talking about taking the punch bowl away, and the fact that investors have to adjust to a new reality in terms of not unlimited quantitative easing, that's been potentially taken off the table. Investors are now going to have to focus much more on the macro economic outlook, i.e. the prospects for growth going forward, not only in the UK and the US, but also in Europe as a whole. And let's face it, if you look at Europe as a whole, the picture is pretty grotty. So investors are now going to have to start focusing much more on the macroeconomic fundamentals of individual companies rather than just basically looking at stocks and buying en masse. And I think overall that could limit further upside in equity markets. Now, we've seen a bit of a base come in round about the 6,000 level on the FTSE 100. I think to really stabilise, we need to get back above 6,250. For the S&P 500, we need to get back above the 1,600 level. And I think that overall really will determine whether or not where the future direction is. Now that Mr. Bernanke has said that any further asset purchases are going to be data dependent, you can be sure that any good economic data out of the US is going to hasten concerns about a pullback in tapering. And as such, good data could actually limit stock market upside. Okay, so that's pretty much it for this week. Once again, thanks very much for listening. This is Michael Hewson talking to you from CMC Markets.